for now, I will hand over to Andrew.
Good evening, everyone, and thanks for joining us today. We're going to be talking about something that comes up in almost every conversation we have with clients: how to enjoy your retirement whilst also leaving something meaningful behind. For a lot of people, these two things feel like they're pulling in opposite directions. On one hand, you've worked hard and want to enjoy it, whether that's traveling, spending time with family, or just having peace of mind financially. On the other hand, there's often a strong desire to pass something on to children, grandchildren, or even causes that matter to you. What we see in practice is that people can end up caught in the middle, either holding back from spending because they're worried about the future or unsure about how much they can give away safely. Today is really about showing that it doesn't have to be an either-or decision. With the right structure and a bit of forward planning, it's possible to support both goals.
Andrew,
just briefly.
Sorry, Andrew. I just wanted to remind you, you need to go back a couple of slides to the agenda.
Oh, I do apologise.
There we go.
Okay. So just a quick bit of housekeeping before we get into it. We'll run through the session in a few clear sections, and we'll keep things fairly structured so we stay on time and ensure we don't miss anything. The runtime will be around 50 to 60 minutes. If you do have any questions as we go, then please send them in via the Q&A panel, and we'll make sure that we pick those up at the end. There'll be time set aside for that as well. So we'll be recording the session, and the recording will be shared with all the registrants after the session. As I mentioned, you'll also hear from all three of us today, each covering different parts of the topic, so you get a well-rounded view rather than just one perspective. So in terms of what we're going to cover today, in part one, we'll start with the big question, which is how to balance enjoying your retirement with leaving a legacy. Then we'll look at what legacy actually means in practice, because it's often broader than what's just left at the end. We'll touch on the tax landscape, just enough to understand why more people are being affected. Then we'll walk through the main planning options in plain English, what they are and how they're typically used. And then we'll move into trusts and how they can help with inheritance tax planning in the next section with Callum. In part two, retiring well, we'll look at why people hold back, the common reasons why, and potentially what can be done to solve this. We'll then look at an example of cash flow modelling and how planners use these to support decision making. Then ending with some next steps. And part three will be our Q&A, with each of us taking some of your questions. Now, this is the question that really sits underneath everything. Can I enjoy the retirement I've worked for and still leave something behind? What we tend to see is people erring on one side or the other. Either they're cautious and holding back from spending, or they're unsure about what's safe to use. A big part of that is uncertainty, not knowing how long your money needs to last or what future costs might look like. That can make it harder to feel confident. And that uncertainty often leads to inaction or overly conservative decisions. What we'll show today is that with the right planning, you can create a framework where spending and legacy aren't competing, they're working together. Now, there are two kinds of legacies. When most people hear the word legacy, they think about what's left at the end, the financial inheritance. That's what we call the capital L legacy. That's typically dealt with through wills, trusts, IHT planning, and pensions. But there's also what we call the little L legacy. Typically, this is dealt with, this is everything that you do during your lifetime, rather. Now, that might be helping family at key moments, supporting them financially when it matters most, or creating shared experiences, perhaps helping children on the property ladder or through university, or treating them to family holidays. What's interesting is that many clients tell us those lifetime decisions actually feel more meaningful because they can see and feel the impact directly. So part of good planning is shifting the mindset slightly, from legacy being something that just happens at the end to something you actively shape along the way. One of the most practical ways that this comes to life is through gifting. Traditionally, wealth is passed on later, but increasingly, people have been choosing to help earlier when it can have the biggest effect. So, for example, helping children get onto the property ladder. That support at the right time can fundamentally change their financial trajectory, whereas the same amount later may not have the same effect. The same applies to education. Helping with university costs or reducing debt early on can give someone a much stronger starting point. And it's not always about large financial gifts. For some families, it's about experiences. So helping fund time together, holidays or opportunities that might not otherwise happen. There's also an emotional side to this. Rather than wondering what difference your money made, you get to see it firsthand, which is something many people value highly. Of course, this needs to be done carefully. You still need to maintain your own financial security and flexibility and be aware of the rules. Inheritance tax is becoming more of a consideration for more people than it used to be. Historically, it affected a relatively small number of estates, but that's gradually changing. We're also seeing pensions becoming more relevant in estate planning, particularly as rules evolve and how they're treated changes over time. So from April 2027, as you may or may not be aware, they'll form part of the estate when an individual passes away. There's no denying that this is a massive change. Thresholds have been frozen until 2030, and rising property prices are contributing to this increase in liabilities. As house prices have increased over time, more estates are naturally moving above the thresholds. Pensions remain incredibly tax efficient, but their use has now changed, or rather it's reverted to their original purpose. The key point here isn't to focus on technical detail though. It's simply to recognise that doing nothing is increasingly a decision in itself. For many people, a small amount of planning can make a meaningful difference, whether that's reducing a potential tax bill or improving how assets are passed on. And importantly, planning doesn't have to be complicated, it just needs to be considered. When it comes to planning, there are a number of different tools available, and it's usually about combining them in the right way rather than relying on just one. So let's have a look at some of these. And the first is life assurance, and one of the more straightforward options. It can be designed specifically for inheritance tax planning. The main advantage here is simplicity and certainty. Rather than reducing the inheritance tax bill itself, the policy provides a lump sum on death that can be used by beneficiaries to pay their tax liability. That can prevent assets such as the family home or investments needing to be sold quickly to cover the bill. And another key benefit is speed. If the policy is written into trust correctly, the proceeds usually fall outside the estate and can often be paid quickly to beneficiaries. This helps with liquidity at what is usually, or understandably, a very difficult time. Liquidity issues could be caused by the death of a sudden loss of income from employment or defined benefits or state pensions, for those who perhaps were relying on that person for financial support. However, there are some drawbacks to consider. Premiums can become expensive later in life, particularly if health conditions exist, and in some cases, the cost over time can be significant. It's also important to remember that this strategy doesn't actually reduce the inheritance tax liability itself. It simply creates funds to meet it. And finally, the trust arrangement must be set up properly. If not written into trust, the payout could form part of the estate and potentially worsen the inheritance tax liability position rather than improving it. Now, the second here is property. Proper property planning, either through gifting property or during your lifetime or through equity release, can reduce the taxable estate. The major advantage of this is often that it tends to be one of the largest assets within an estate, so reducing its value can have a substantial impact on inheritance tax exposure. Lifetime gifting can be very effective if the individual survives 7 years after making the gift, as the assets may then fall outside the estate completely. Equity release can also reduce the taxable estate because borrowing secured against the property lowers the net estate value. However, there are several important risks and considerations. When gifting, the 7-year rule is crucial. If the donor dies within 7 years, some or all of the gift may still be subject to inheritance tax. There are also gift with reservation rules. So, for example, if someone gifts their home but continues to live in it without paying market rent, HMRC may still treat it as part of the estate. And another consideration is care fees and financial security. Giving away property or releasing equity may reduce future flexibility and available funds later in retirement. So, while property planning can be highly effective, it requires careful structuring and long-term planning. And then the third point here is business relief investments. These are qualifying investments, often into certain AIM-listed companies or unquoted trading businesses, which can become exempt from inheritance tax, or at least reduced at a rate after the changes that have happened this year, once they've been held for 2 years. One of the key benefits, is speed compared to other estate planning strategies. Unlike the 7-year rule on gifts, business relief can potentially provide inheritance tax relief after only 2 years. Another advantage is that the investor retains access to the capital, unlike an outright gift, where assets are permanently given away. However, these investments come with significantly higher risk. Many qualifying companies are smaller businesses, which means they can be more volatile and less stable than mainstream investments. Capital values can fall and returns are not guaranteed. There are also generally less liquid investments, meaning that it may be harder to access funds quickly when needed. In addition, business relief status depends on tax legislation and qualifying rules remaining in place, so there's legislative risk to consider. Because of the investment risk involved, these solutions are normally only suitable for clients with appropriate risk tolerance and wider financial security already in place. What it really comes down to is balancing three key things here. 1, maintaining access to your money. 2, managing risk appropriately. And 3, improving tax efficiency where possible. And the right balance will look different for everyone, depending on their circumstances and priorities. So I'm now going to pass over to Callum Venn from Octopus Legacy, and he'll be talking to you about trusts. Callum.
Lovely. Thank you, Andrew. Perfect. Yeah, so I'm just going to introduce myself first. So I am a solicitor, as Andrew said, at both Octopus Legacy and Octopus Legal Services, covering all things estate planning, and then also in the regulated sector with lifetime trusts and estate administration. So I really want to kind of expand on what Andrew was saying there in relation to gifting, which naturally goes hand in hand with trusts and whether you want to gift some of your assets into trusts and whether that can be a beneficial thing for you to do. So just a few things that I'll be covering off, kind of go over again the rules on gifting, some considerations about what is a trust and the types of trust and why you may want to use them, and some important considerations for you to have a think about whether you think trusts are going to be right for you. So to kind of go over again slightly what Andrew said there, the rules on gifting. Apologies for the rather wordy slides. I am a solicitor, so it's not really avoidable, unfortunately, but generally, anything over your nil rate band, 325, you may then have to start paying inheritance tax. As you said, gifting is a way of potentially reducing any kind of liability. On the screen here, we've got the rules around the gifting. So the simple rule, the annual exemption, everyone has £3,000 per tax year that you can make without impacting any tax liability. And you also have a small gift allowance of £250 per person. There's the wedding and civil partnership gifts that can be made, either £5,000 to children, £2,500 for grandchildren, or £1,000 to anyone else. And those are kind of the allowances that people may want to make use of. The regular gifts out of income, that's kind of a misunderstood or rather misused gifting format that can be utilized. If you have any income producing assets, let's say a second home, maybe rented, or an investment that's producing income, that surplus income could be gifted to your family, to your friends. Rather than incurring additional wealth, you can get that out, assuming it doesn't reduce your standard of living. And the 7-year rule that Andrew mentioned there, any larger gifts above your £3,000 or any of these allowances, if you survive the 7 years, that gift in theory is outside of your estate. If you were to die within the 7 years, then that would be in the estate for tax purposes. When it comes to trusts, gifting is you are gifting into the trust. So these rules, particularly the 7-year rule, that also needs to be taken into consideration. So what is a trust? A trust is a way of managing assets, whether that be money, property, investments, or businesses. It's a legal arrangement where someone transfers the assets for another person to look after on behalf of somebody else. So you've got three important parties here. The settlor, which would be yourselves, they're the ones that create the trust by creating the trust deed, and they're the ones that will be transferring the assets. You would appoint trustees. They're the people who manage the trust under the terms of the trust deed. And then you have the beneficiaries. They're the people, the person, or indeed the charities that will benefit from the trust, depending on what type of trust you did want to create. Obviously, it depends on who the beneficiaries would be. How are they created? Two most common ways of creating a trust. It's whether in your will that is enacted as a result of your death, or you can create them during your lifetime. So the creation of lifetime trust is a regulated activity. That's something that myself at Octopus Legal would be able to assist you with if you were ever looking to create a trust during your lifetime. Trusts in the industry have famously been missold. I think they may be in the news this week. In fact, people have been missold family protection trusts or asset protection trusts with claims of reducing all inheritance tax or meaning care home fees will never need to be paid. That's not necessarily true. We unfortunately do come across numerous trusts that have been misunderstood when they were created, and they have led to issues that do cost quite a bit to resolve. They are not the silver bullet that cure everything. They do have a lot of uses, which I'll go over, but it's not the one thing that will fix everything in relation to IHT or probate. I mean, our approach at Octopus is to keep everything as simple as possible. Kind of hard to do when we're discussing trusts because they are naturally complex, but we try and make sure everyone has full knowledge about what they are getting themselves into and what they are signing up for. Quite important, the financial advice. Obviously, the financial advisors to assist you. It's very important that you get the right advice and understand that a trust is something that would be right for you. Just to go over some types of trust that you may want to consider to help you in your planning for your retirement. Again, it's all a form of gifting. How can we get assets out of your estate, reduce any potential inheritance tax? What type of trust may be useful? So some of the common types of trust that I would like to just touch upon would be bear trusts. We've got discretionary trusts, vulnerable persons trusts, and pilot trusts. Bear trust, again, very wordy slide here, but a bear trust is the most simple form of trust. It's where a settlor is giving assets to trustees to hold on the absolute and immediate right for somebody else. So the most common type is if you wanted to give some assets to your children or grandchildren if they're under the age of 18. If you wanted to, let's say, leave £50,000 to all of your grandchildren, if they're under the age of 18, they cannot accept that money themselves. They don't have the capacity to do that. So therefore, creating a bear trust, you give the money to a trustee, they hold that money on behalf of those grandchildren. When those grandchildren turn 18, that money then becomes theirs. The standard 7-year rule would apply on these gifts. So rather than waiting for grandchildren to reach the age of 18, you could leave these gifts now. 7 years pass, and then the clock starts ticking earlier. Discretionary trust. This is where you put an asset into a discretionary trust, and the trustees have, funnily enough, full discretion as to who gets what out of that trust. You would have a long list of potential beneficiaries. No one has an automatic right like you would in the bear trust. Here, it's fully at the trustee's mercy as to who gets what. Usually you would have a letter of wishes explaining why you set up that trust and for what purpose, but they have full flexibility to use that trust fund as they see fit. Some people want to cater for future generations. These types of trusts can go on for 125 years. So you may want to allow for that for future generations and passing down family wealth amongst your own bloodline. The big factor here is that bottom one, the tax, which puts many people off. Payments into a discretionary trust could be subject to an entry charge of 20% if it's above the annual, the nil rate band of £325,000, which is obviously could be quite a sizable chunk if you're putting quite a bit of assets into there. You've also got the anniversary charges, which are payable every 10 years, and also exit charges as well. And trusts do have higher rates for tax for both income and capital gains that should be factored in as well. And then got vulnerable persons trusts. So if you wanted to gift to somebody who is not able to manage their own affairs, this could be the option for you. It works like a discretionary trust, but it has some tax benefits of no immediate inheritance tax charges, and also the income and capital gains rates can be lower. They can be very useful again if you wanted to get assets out of your estate, but the person that you want to give money to is not able to deal with their own finances. So they can use this trust as a way of managing the assets for them. It would also not impact any state benefits that this vulnerable person may be in receipt of, because the assets are not owned by them, it's owned by the trust. And then we've got pilot trusts. So these are kind of set up during your lifetime, and you normally don't have any assets in there until you die, when you may allow for a life assurance, which Andrew mentioned earlier, or even any kind of inheritance to then be received by this trust. It's basically the pilot flame, I think, is the terminology here. Most commonly used to prevent the value of a lump sum payment being received into a surviving partner's estate. So if the payment is not in the survivor's estate, it cannot be taxed on their death because it's held in the pilot trust rather than outright to the other spouse. So it's a good use for these. There's no initial taxable event on these types of trusts, but they would be taxed under the usual relevant property regime, like the discretionary trust, once they have the assets. There's many considerations to have a think about if you were looking to set up some lifetime trusts. Touched on there the immediate and ongoing tax charges. I mean, this does put quite a few people off. If you were looking to do a discretionary trust, put assets in there, you would be looking at a potential tax bill there and then, again, going on the 10-year annual charges and also the exit charges. There's also the impact on the residence nil rate band. That's where you can claim an additional £175,000 on an estate if there's property going to direct descendants. If you have put the property in the trust and it's no longer going to direct descendants, you could miss out on that band. So you may just want to have a think about that. Trustees' duties, I think this is one of the most misunderstood parts of this area, is the ongoing obligations that trustees have. In short, any layman, any non-professional trustee is not able to charge for being a trustee, and they have a long list of rules and obligations that they need to meet. As long as they act in good faith and act in the best interest of the beneficiaries and obey the trustee, they should be okay. But it is almost a full-time job being a trustee, especially if there's a large trust fund. So it's definitely something you may want to factor in. We've also got a loss of control. Once assets are transferred into a lifetime trust, you may no longer, well, you won't own them directly. You may be a trustee. You may have to work with other trustees, so you don't necessarily have the control that you would have if that asset was in your sole name. I know these final 2 points were mentioned by Andrew a few slides ago. Gift with reservation of benefit. Any gift that you make, that's whether it's into a trust or not, it has to be a gift. Therefore, if you transfer a home into a trust but you continue to live there, you potentially may have to pay full market rent to the trustees to be able to do so. It can be very messy, and this is one of the big issues where people have set up trusts for their property. Nothing's been done from a tax point of view or from a rent point of view. Therefore, IHT purposes, that trust would fail, and it can cause a bit of a mess. And we've also got the deliberate deprivation of assets as well. If care home fees are likely and you decide to gift or indeed gift into a trust, then the local authority may look through that trust completely in relation to their means test for care fees. Next steps. First port of call for any form of gifting or creating a trust would be to get financial advice with your lovely financial advisors. They can do a financial forecast, work out what form of gifting you may want to do, whether you do want to look at creating a lifetime trust. And then that would lead us to the legal advice and coming to us at Octopus Legal to instruct a solicitor to help you create trusts. We can also then help you with transferring assets from your names into the names of the trustees. And then also then comes the trust administration, where the trustees are then responsible for dealing with the trust. There is some more admin in relation to trusts. So nearly all trusts now need to be registered with HMRC. It's via the trust registration service, so it's just something else for you to also factor in. Every trust needs to be registered within 90 days of creation, and that just needs to be kept up to date. If you had, let's say, 10 different bare trusts for 10 different grandchildren, then 10 different trusts would all need to be registered with HMRC. How can we help? As I said, at Octopus Legacy, we're both an estate planning company and also a regulated legal company. So if you did need any assistance with your estate planning, wills, lasting powers of attorney, or indeed a discussion on life insurance, we can assist you with that. if you did want to, after you've obtained your financial advice, if you did want to go ahead with your trust creation or even trustee assistance or anything like that, then we can also help you out that way. Lovely. Thank you.
Okay, thank you, Callum. So we're moving on now, and we're going to look at why people hold back in retirement. So when we speak with clients approaching or in retirement, a common pattern emerges. Even those with substantial assets often hesitate to spend. There are four main drivers behind this. The first here is longevity. People are living longer than ever, which is obviously a positive, but it does create uncertainty. If you don't know whether retirement will last 20 or 40 years, it's very difficult to feel confident about spending today. Second here is care costs. Later life care is both expensive and unpredictable. Clients often don't know whether they'll need it, when they might need it, or how much it could cost, so they default to caution. Third is inflation, and even at moderate levels, inflation erodes purchasing power. That creates a concern that what feels like enough today may not be enough in, say, 10 or 15 years. And the fourth is market falls. Sequence of return risk is poor performance in early years of retirement can hit hardest and can affect the long-term wealth of someone more negatively than someone who experiences strong returns in the early years. Therefore, deciding on the right level of risk is essential at that stage. Now, when you combine these, the result is understandable. People can hold back. They spend less than they could, delay decisions, and often don't enjoy the money as much as they might have been able to. All of this uncertainty leads to one central question, and it's the one we hear more than any other. How much can I actually afford to spend and potentially give away? Not in theory, but in a way that feels reliable and grounded. Clients don't just want a number, they want confidence. They want to know they can enjoy their lifestyle, support family if they choose to, and still remain financially secure. And this is exactly why traditional planning often falls short, because static projections don't fully answer that question. Now, the way we address this is through what's called cash flow modeling. Cash flow modeling is essentially a way of bringing a financial plan to life. Instead of looking at static snapshots like current assets or income, it maps out how everything evolves over time. We input key variables such as income sources, expenditure, assets, inflation, growth assumptions, and then from there, the model projects forward year by year. And then we also run stress tests to show the impact certain negative events may have on the plan. But the real power is in its flexibility. We can adjust assumptions, for example, retiring early or later, increasing or decreasing spending, or making gifts. And instantly we see the impact. It's a living, breathing model. So rather than relying on guesswork, clients can see a structured, evidence-based view of their future and how different decisions affect outcomes. It shifts the conversation from uncertainty to informed decision-making. So let's take a look at an example of cash flow modeling. When looking at cash flow outputs, it's important to understand what we're actually seeing, because the values come from interpretation and not just the charts itself. Typically, the core chart shows assets over time, often as a line declining gradually through retirement, as you'll see here. This example shows retiring at age 60 and runs all the way up to the age of 100, as more and more people are living longer, as we touched on earlier. This illustration shows a person's various assets. We see a combination of pensions and savings and the impact spending has on wealth over time. This will differ for everyone, but this is a typical example. The different colors represent different assets and how they increase or decrease over time. You'll see that there is more of a decline in the early years of retirement, and that's between ages of, say, 60 to 67, which tends to be the most expensive and have the biggest drain on assets. That's assuming if somebody does retire at 60. Once state pensions kicks in, this reduces as the reliance on savings and pensions decrease. Now, in this example, we can see that the clients can comfortably afford their spending over their lifetime under normal market conditions, and they'll still have over £600,000 at the age of 90. Which on one hand may sound reassuring, but on the other hand, it can create an inheritance tax concern. And remember, this is excluding the value of people's property. Things change considerably under unfavourable conditions. Here you'll see the impact that low growth rates or similarly high inflation will have on overall wealth over the same time period, starting with the same level of assets. Specifically, we want to look at what happens if inflation stays higher than expected, what if investment returns are lower, what if care costs arise later in life, or even if the financial position of one partner dies prematurely, will the other still be financially okay? We stress test the plan against these scenarios to identify and then manage the risks. Another key element is comparison. We can model different options side by side. For example, spending more now versus later, gifting versus retaining assets, retiring at different ages. This helps clients see trade-offs clearly. And what we see here is a very different picture than what we saw in the previous slide. By the age of 95, under unfavourable conditions, the same clients could potentially find they've exhausted all their funds. And it's illustrated here by what we see and what we call a red tail. And finally, here we see how expenditure is being met by income, with each colour representing a different income source. We see the pensions, the ISAs, the state pensions all listed here. And the solid black line at the top is the total expenditure. And the dotted black line is what we call the core spending. All those expenses, that must be paid each month, things like costs, bills, groceries, direct debits. And then the difference between the two would be the discretionary spending. They're things like meeting friends, holidays, sports, gyms, memberships, those sorts of things. And as you can see, both of these are met and there is no shortfall. However, if there was a shortfall, you'd see that the colours would not meet the black lines and it would be all white, and that would be a concern. So the order in which to use these assets is also an important consideration and a key point of discussion with clients. This is what we call the drawdown strategy, and we aim to be as tax efficient as possible to ensure that funds can last as long as they can. So once clients understand their position through modelling, something shifts quite noticeably. First, spending becomes more confident. Instead of holding back just in case, clients can see what's sustainable and enjoying their money accordingly, removing the element of guilt or worry in their spending. Second, gifting decisions improve. Rather than worrying about giving too much too soon, clients can see the impact of gifts in advance, which often leads to more meaningful and timely support for clients. Third, legacy planning becomes intentional rather than accidental. Instead of simply leaving whatever's left, clients can shape what they pass on in line with their values. Ultimately, modelling connects everything: lifestyle, family support, and long-term outcomes into one coherent plan. It turns financial planning from something abstract into something tangible and actionable. So we're going to round things up with a few key takeaways today. The first is retiring well and leaving a legacy aren't in conflict. With the right plan, it may be possible to do both. The tension is real, but it is solvable. The IHT landscape is about to change. Pensions are no longer the safe haven that they were. So review your strategy now. You have more options than you think: gifting, trusts, life assurance, BR investments. Each may have a role depending on your situation, and they are worth exploring. Cash flow modelling is the foundation to good financial planning. It turns everything discussed today into a plan that's personal, visual, and revisable. So thank you for your time today. I hope you found the presentation useful and informative. And if you'd like a free consultation with an independent financial advisor, then do get in touch. We can help you explore your retirement and estate planning, plus review your position with the cash flow modelling that we've discussed today. There's no pressure to make any decision during the consultation, and you'll always have time to reflect. So feel free to follow the QR codes here for an appointment, or to complete the Life and Legacy profile quiz at the bottom here. That will help you have a think about whether or not you're prepared for retirement, and it will then It will also provide you with a detailed PDF that's sent direct to your email inbox. There are a few regulatory points to cover off before we move to the Q&A, and I'll leave these up for a moment for you all to read as well.
Thanks, Andrew.
Okay.
And thank you very much, Callum. So before we go on to the Q&A, I'd just like to highlight that Callum has kindly addressed a couple of questions that have come through on the Q&A function. So just to kind of run through those in case you haven't seen them. One question was, full market rent could be quite broad. What is the typical leeway? And Callum's response there is that we would recommend getting a professional valuation, either through letting agents or chartered surveyors. The other question, which I think is a really good one, is gifting from surplus income subject to the 7-year rule? And Callum's response there is, it is not, provided that it is surplus income and does not reduce your standard of living. It is always best practice to keep excellent accounts if you want to use this as a gifting option. So I just wanted to run through those questions that have already come through. I'll then, Andrew, if you'd like to flick over to the next slide.
Yep.
Just to remind you, as we're going through the Q&A, that there is the option for you to book a consultation with one of our independent financial advisors if there are questions that we haven't been able to answer in the detail that you might be looking for. So, Callum, I'm going to throw the first question over to you, which came in through one of our registrants. The question is, how can I protect my assets from the council grabbing them to pay for care fees?
It's a tricky one. It's all about timing, I think, is the most important factor. It's when you go into care, whether the level of funding that you may need to fund yourself, it's all done on a means test. So what means do you have? Naturally, if you have a property, you're probably well over the means. If the assets are in your name, then yet potentially the local authority could get their hands on them, as you put it. They could, force a sale, etc. It's only usually relevant if the assets are in your sole name or you are a survivor from a spouse or civil partnership. If you go into care and you've still got a wife or a husband in the home, then the home wouldn't be looked at for means test. If you're receiving care in the home, then the home wouldn't be used for the means test as well. Likewise, if you're getting care under the NHS, obviously that would be funded via the NHS rather than through the local authority. But that being said, if the property is in your sole name and you need to go into care, you need to fund your care, then yes, unfortunately, the local authority may be thinking we may need to put a charging order against that or kind of force a sale. Anything that you do for the sole purposes of not paying care fees is kind of a big no-no and a big grey area, red flag, whichever terminology you want. If care is likely and then you do deliberately deprive yourself of assets, then again, that's a big no-no. The answer is, if you have surplus assets that you want to avoid from paying care potentially or give them to your children or other people, the sooner you do that, the sooner you think about gifting, whether into a trust or to them outright, the better. Obviously, if you survive the 7 years. If care is not likely, if you're in your 50s, 60s, 70s, you're really healthy and care is not likely, then local authority are less likely to cause any issues. If you're quite poorly and there've already been discussions about your care plan and where you're going to be receiving care, then that's a bit more of a tricky issue.
Thank you, Callum. I'm going to now throw over to Chris. The question is, any tips on a glide path into retirement when considering a bucketing strategy? For example, when and how to fund 2 years living expenses to mitigate against sequence of returns risk.
Thanks, Les. It's a great question and quite a common one, actually. So if I set the scene on a scenario where this would obviously be applicable. So if we've decided and gone through the process of financial planning and we realize that a client actually wants to retain assets, so that may be a number of, let's say, DC pensions and perhaps some ISAs and general investment accounts that they actually want to retain rather than, for example, purchasing an annuity. One of the biggest risks we have, obviously, in retirement is when you start retirement and you suddenly have a big loss and you have a poor returns, that is possibly the worst thing that could happen as soon as you start drawing money down from your assets. So that is essentially what sequencing risk is. And at Flying Colours, our planning places a strong emphasis on, as Andrew said, the cash flow modelling, looking at the suitability and capacity for loss when we try and build the strategies around the sequencing risk and putting this together for clients. So the framework I typically use is a 3-bucket approach. It's quite a common one actually, but there's essentially 3 buckets. The first one is what I call the short term or the now bucket, and that can cover for us we have a minimum of 1.5 years, but in the example here it was a couple of years up to say 3 years, dependent on the risk profile of the client and obviously the spending trajectory as well. So that's our sort of first bucket, and that obviously is very low volatility and probably mainly cash. The next one, the medium term, or what I call the next bucket, is slightly more diversified, but again, a lower risk asset. So that could be, let's say, if the client was naturally risk profile 7 or 8, we would look to reduce the risk in the medium term bucket down to maybe a sort of 3 or a 4, and it just protects against obviously big market movements. And then finally, we have the long-term later bucket, which is really the growth driver and hedges against inflation, because obviously we still need the real growth over time to support income in retirement. So we have these 3 buckets that kind of manage and mitigate that sort of sequencing risk over time. And really the point for each of those buckets is that it tailors specific requirements for the client's objectives, their risk profiles I mentioned, factoring in the tax position. So if we're sort of straddling different tax brackets, we want to make sure that we're tax efficient. We may be looking at drawing on ISAs or obviously the tax-free cash from pensions to help with extra spending in the early retirement, or what I call the go-go years. So that's important, as well as capacity for loss, because some of us are able to stomach greater losses than others. So that's very specific to individual clients. So that whole structure and that framework helps reduce the need to sell growth assets during volatile markets, because we've got that now bucket, which gives us that sort of cash, low risk assets that don't really get impacted by, for example, obviously the Trump tariffs or the Iran situation recently, where we did see market volatility. One of the really important things again about the sequencing risk is actually the behavioral resilience around this as well, because a lot of retirement planning is around that sort of behavioral understanding, and we naturally want to do something when something happens in the markets. And I think that the discipline of being able to understand what's happening with the plan, knowing what's happening in the future, and really sticking to what we're trying to achieve over time is so important. And quite often I do have people come to me and who become clients and have had experiences where something happens in the market and they've sold and crystallized losses, unfortunately. So managing that drawdown risk cost effectively and protecting liquidity management and having diversified portfolios, flexible withdrawal strategies, and that strong behavioral coaching really is what that's all about. So yeah, that's a great question.
Brilliant. Thank you, Chris. So it sounds like there's a kind of framework there, but actually the detail of that is which is simple, but the detail of how you structure those buckets can be quite complicated.
Yes, yeah.
So yeah, brilliant. Thank you. Callum, I'm going to throw back to you. So again, this is another question that was submitted in advance. If your planned assets and defined contribution pension at death take you over the £2 million level, but you are relatively cash poor for what you'd like your ideal expenditure to be, such as doing travel and holidays, are trusts the only approach to keep a legacy for your children?
Are they the only option? No. Are they an option? Yes. I think it all kind of is a balance of lifetime needs, IHT risk, passing on wealth. You need to there's no off the rack solution. I think if you're, cash poor, it does kind of limit the options available to you to be able to make gifts or legacies or what have you, and, ensuring that property does go down to children or whatever it may be. But it may be a consideration. But yeah, if there's the property involved, for example, I know we discussed equity release or something like that. That's always an option of, liquefying, obviously get financial advice and everything before you're going to be doing something like that. But it's not the only option. I think, yeah, there's still that misunderstanding with trusts of what they can do, this magic thing. And, it could be even simpler, doing other types of gifts and things first before saying that's the only solution.
Great. And then Callum, while I've got you, a question that's come in this evening, and if this is too complicated and we need to do a follow-up, please do say. But the question is, what about discounted gift trusts?
Yep, they are an option. It's basically as a way of you're able to give assets away that still enjoy payment for the rest of your life. That's kind of the short term of what a discounted gift trust is. That is the perfect example of getting financial advice before speaking to a solicitor on these types of trusts. They can, with the financial forecast, work out what kind of payments that you may need for the rest of your life, what kind of income, but also guaranteeing some form of payment to beneficiaries in the future. They're maybe, yeah, misused, well, not misused, misunderused. Yeah, it's definitely something that you may want to speak with your financial advisors and look into doing something like that. It is an option, absolutely.
Okay. And then another question, which is related to trust, is there a minimum estate value guide above the £1 million mark where trusts are worth the kind of extra work and the effort?
No, I'd say is the short answer. It depends, what your context, what the purpose, what you're trying to achieve. If you've got £10 million, then you could have a trust. That's going to be a hefty entry fee to pay if you're putting all that into a trust. Likewise, if you've only got £50,000, but you want to put that into a trust, that could still be beneficial. There's no set amount. Yes, there's costs involved of creating trusts and having accountants, etc., making sure everything's all correct. So the bigger pot of money, then the easier it is to justify. But if your context is, there's somebody who's terrible with money, you want to leave them a gift, but you don't want to leave it to them outright. Therefore, a discretionary trust, whether it's for £10,000 or £10 million, there's no set figure.
Okay. So it's not all about trying to save inheritance tax. There's actually
No,
other
it
reasons.
it can be, once the asset is in the trust, it's outside of your estate potentially. So yes, it can be helpful for inheritance tax, but they don't just have one purpose. It depends why you want to do that, as opposed to I have X amount.
Great. Thanks so much, Callum. Andrew, you haven't had to talk for a few minutes, so I'll bring you back in. Um, so one question we had from the registrants was thoughts on gold. I guess what they're asking is, should you be invested in gold?
Again, a good question, and something that's quite hard to ignore over the last few years. Gold has been on a rise for some time now, multiplying many times over and really strong at the moment. The question I sense behind this is, should I go all in on gold because it's going to continue this metaphoric rise that we've seen in the past? Of course, I can't advise around this, but what I would say is gold has its place. It's in the past been a place of safety to hedge against currency risks. But remember, putting all your eggs in one basket is incredibly risky, whatever that may be. So gold historically hasn't outperformed equities. Remember that. It also doesn't produce any type of an income. But I certainly do think that it is important to form part of a well-diversified portfolio, and something we absolutely believe in.
Someone explained to me once that gold is only ever worth what people are prepared to pay for it.
That's right. Yeah,
You don't
absolutely.
earn interest from it, you don't earn rental income from it, you don't earn dividends from it. So
That's right. Yeah.
it sort of has that risk to it. Okay, so next question I will throw over to Chris, and this is around annuities, with the person asking if they are still a good option in the retirement planning stage.
Another good question. So yes, in short, annuities absolutely still have a role, particularly now rates have improved significantly over recent years. I think there's a lot more conversations around annuities now when I'm talking to clients. I think the key with this is not viewing retirement planning as either drawdown or annuity. I think in most instances I'm looking at a blended strategy where, for example, the annuity forms the the core expenditure that Andrew alluded to earlier, and covering the sort of base costs of running one's lifestyle. And then that sort of gap where you want to go on holidays and have sort of pleasurable things that you want to do in retirement, you can use the flexibility of your DC pension, for example, instead, and just draw down on that as you need. Again, I alluded to that sort of go-go years where we tend to spend more and have that flexibility of using that tax efficiently as well, because that's also possible with the DC pension with the tax-free cash. At Flying Colours, we use a hierarchy of needs approach. So for many clients, annuities can be helpful alongside your state pension, your DB pensions, and other guaranteed income, as I said. They work really well for clients who want that certainty. So some clients just do not want to have that responsibility or having to deal with their investments in retirement, and annuities have a place for those sort of clients. And also those with lower capacity for loss, where, as I said before, it really is too much to stomach with that sort of drop that you can have sometimes with geopolitical risks. So my approach is usually to secure the core spending first, then use perhaps flexible drawdown for discretionary spending, and inflation protection and legacy planning as well, to kind of think about in all of this, because when we're doing this sort of planning, all of these things cross over, and it's not simply annuities or drawdown. So yeah, but great question.
Lovely. Thanks, Chris. So a couple of questions have come in relation to gifting out of income. And I'm going to kind of throw it open and you guys can fight over it. So the first question, so they're relevant. So one is, what counts as income for the purposes of gifts out of income, especially during retirement? So would that include dividends paid out from ISAs, interest, tax-free cash, defined benefit pension income? So what can we have a definition of what income is? And then the related question is the income calculated on a tax year basis or on a calendar year basis? Any takers?
So I think the important thing to remember here is that it's important to keep records. If you are going to be taking a regular income from, say, a DC pension, it needs to be regular. It needs to show that it is excess. But yes, it certainly can include other income from perhaps properties or dividends, a variety of those. But it's important to make sure that it is well documented and it is not seen as a disposal of capital or other assets.
Yeah, just to add, that's the key clincher there, not capital. If it can potentially be capital, then yeah, to HMRC's point, that wouldn't be income. It has to be purely income, not capital.
Could you define what you mean by capital?
As in the physical asset itself, so whether that's the shares, whether that's the property, obviously the income is what's made from that, from the capital itself.
Brilliant, thank you. We do have quite a lot of other questions, but I'm afraid some of them are very, very specific and detailed, and I fear that we just wouldn't be able to actually answer it thoroughly. So thank you to everyone who has submitted their questions. We do have a few minutes left, so I'm just going to finish on one. Again, this came in as part of the registration process, and I'll hand over to Chris for this. So if someone has stocks and shares, ISA, DB pension and DC pension, and working part-time, as well as being partially retired, the additional income tax rate is 45%. What is a tax efficient way to withdraw money from these accounts?
Great question, and lots going on there. So I'll try and cut to the chase really on this. So again, this is where holistic financial planning becomes really important, because we're looking at different ISA, different wrappers, ISA, the DB, the DC. We're looking at somebody who's obviously a high rate taxpayer as well. So we've got a lot of things we need to try and balance here around the income tax, retirement sustainability, the sequencing risk that I talked about earlier, and estate planning as well. So I'm sure all of that is at play here. So if someone's still working part-time and already paying additional rate tax, then generally you don't really want to be drawing any more taxable assets. So you'd be looking at potentially taking tax-free cash, or looking at the ISA to generate that additional income or capital requirements. So that would be the first port of call, and obviously, you know, that depends again specifically on the client needs and how much they're looking to try and take out, and obviously manage that over tax years. But obviously, historically, pensions have often been preserved because of their inheritance tax advantages. But obviously, following the autumn budget in 2024, obviously April next year, DC pensions will form part of the estate. So we're looking at now at DC pensions more and seeing how we can actually use them to provide income sooner rather than later, given obviously they're forming part of the estate April next year. So a very complex question that I've tried to kind of cover as best I can. But again, that shows where financial planning is really paramount in terms of drilling down into the details of all those moving parts there.
Yeah. Thanks, Chris. And I'll finish on this question because I think it's a good one, which is, at what age do you recommend conducting a pension consultation?
I don't think there's an early enough age. I mean, the more time that we have to work on retirement planning, even if I've got clients in their 30s, and if they're earning exceptionally well, we can start looking at pension contributions to reduce income tax bands. We can actually start to think about what we're trying to achieve over the longer term. And I think with any type of planning, when you start thinking about what you really want to try and achieve over a given period of time, the more time we have to bridge a gap, if there is a gap, the better that is. So I'd always say the sooner the better. And planning is paramount to retirement, and the sooner we can get started, for me, the better.
I would tend to agree. My husband and I were in our 40s, and definitely the guidance we were given then has put us into a far better position now, because we wouldn't have made those decisions. So yeah, I would absolutely agree. And on that note, as I said before, that initial consultation is available to you, and if you'd like to book that, then please do use that QR code. So as we come to 7 o'clock, I'd like to thank everybody for joining us this evening. Thank you very much to Andrew, Callum and Chris for your presentations and for covering off all of those questions. Very much appreciate all of your efforts this evening. And finally, just a reminder that as we